This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. The Fed set to hold rates for the first time in 15 months as inflation continues to cool. European stocks mostly higher, U.S. futures mixed. The UK economy bounces back in April to pre-pandemic levels, fueled by growth in services. Stubborn inflation hangs over sentiment. And we'll be speaking shortly with former Chancellor here of the UK, Nadhim Zahawi. Plus, Donald Trump urges prosecutors to drop their charges against him after pleading not guilty to 37 counts pertaining to classified government documents. So it is a busy day. We look, of course, also at some of the corporate news, with Shell announcing that it will double down on oil and gas. And the focus, of course, for Shell is also extra dividends. The other story regarding oil is the IEA saying that oil demand growth will slow dramatically as it's nearing its peak. Now, that would be a little bit different to what Shell thinks. It'll be interesting to see over the next couple of days and weeks and months what some of the oil experts were trying to get also head of commodities at Goldman Sachs on, to try and really give us a better idea of how and when this will stop. The picture overall is really traders trying to brace ahead of a Fed pause. Does it mean that then they won't hike again in July, or are we back to hiking? What does it mean for cuts that were priced in towards the end of the year? The other story is, of course, sterling. We have a lot of focus on the fact that if you look at major central banks around the world, it's really the Bank of England with the governor, Andrew Bailey, that will struggle the most to get inflation under control. You can see sterling 126.17, and then just on the back of crude oil, you can see 75.08. That's $75.08. So we've gone through some of the cross-asset checks. Let's also talk about what else is going on, which is inflation. The one big thing that we've been focusing on, cooling U.S. inflation, may have sealed the deal for the Fed to pause its aggressive 15-month rate hiking cycle and assess what needs to be done next. Well, joining us now, Stephanie Niven, portfolio manager at 91. Stephanie, thank you so much for joining us. Now, there's a lot going on today, but the firm focused, if I can get my words out, it would help everyone, the focus firmly on the Fed. What happens after? Are you, first of all, expecting a pause today, and what happens after that?
Well, we're very much expecting a skip. So we see the Fed as very data focused. We see them having factored in some of the interesting inflation data that we saw yesterday. And we continue to see them, doubling down on their policy and really responding to the data that's out there. And let's not forget, this has been one of the fastest hiking cycles we've seen. This is historic. And we will see that lag come through. But we really do see that we're on the upper end of that lag. We're on that 2-year kind of trajectory. And that's really a product of having seen low interest rates at the start. We're seeing a lot of the US on fixed rate loans, some of which have been refinanced in the post-COVID era. And, we will continue to see that effect trickle down. But we are by no means done. And the Fed will continue to watch that, and they will be data-driven by their response.
But so, Stephanie, what kind of data are you expecting? If you look at inflation, it's coming down, and a lot of people are saying, look, it's coming down quicker than we thought, and actually the trajectory will continue. Do they really want to see 2%, or will they live with 3% inflation?
So inflation's coming down, but it's not coming down that quickly, and it's proving to be relatively sticky. That core level is still there, and that's still impacting the economy broadly. We continue to think that the Fed will look at unemployment rates, and they originally moved their expectations for unemployment in March. That moved from 3.5 up to 4.6, and those are the levels that we need to start seeing before we really think that the Fed will react. And let's not forget that the Fed has two key goals. It has to look at inflation, and it has to look at that unemployment level. And, we need to start to see the Fed hold tight to that desire to bring inflation down. And also, I think it's important to consider that this inflation cycle has been very supply-side driven. This has not been overheated demand. And I think that changed the mechanism within the US economy. It makes it less clear, less transparent, the impacts that those real kind of considerable credit tightening steps that the Fed have taken, to see them come through will take some time yet.
Stephanie, one of my great reads, actually, when I come in the morning is, of course, John Authors. Now, he says the great inflation scare reaches its final phase, and he says it's all about core services inflation. Do you care about the dot plots, or because it's so data dependent, it doesn't really make that much of a difference to portfolio managers?
We care a bit, but I'm going to be really interested in that commentary, and kind of, is that hiking bias still going to be there? And let's look at the market. I mean, the market is not pricing in a recession. We're not seeing earnings revisions come down, and if anything, those tech moves that we've seen year to date, it's really saved the market and really driven earning expectations back up. And we need to see that those changes come through. We will see earnings revisions come down. And, we need, as stock pickers, to be really focused on those businesses that have that structural growth, that ability to keep pricing, keep growing through macro volatility. And we're pretty, clear that volatility looks likely to really come into the fore in Q4 of this year.
Stephanie, if you look, I mean, I don't know how much of a nightmare it is being at the Bank of England and have to set interest rates, but it doesn't seem like an easy task. What does it mean for how you look at the UK for investment destinations?
So the Bank of England, it's been kind of different in the way they've approached rates relative to the US, because they've been very forecast driven. So we see the Fed as data driven, and that's a fantastic way to think about policy. In the UK, we've been a bit slower and a bit more focused on, forecasts. And the Bank of England was one of the first to react. We saw them raise rates at the back end of 2021, which was, before the ECB and before the Fed. But the rate of those hikes have been slow. ECB has been very proactive and hiked very quickly, and we're beginning to see the narrative within the ECB, and we'll hear more from them tomorrow, but we're beginning to see that transition into persistence of high rates. And I think, in the Bank of England, there's still more work to do. That inflation level's still sticky. That needs to come down, and we need to see the Bank of England be a bit more tough and a bit more front-footed on that.
So what does it mean? I mean, for investments, where do you want to be heavily invested in? We heard from Ken Griffin, which I have to say, it is always interesting because he usually gets these things right. He's loading up on credit, and he's also saying, look, we could see a US recession.
We very much share the view that a US recession seems likely, a consumer-driven recession in particular. And where we try to focus our time is on those stocks, those companies that have sustainability-driven structural growth. So some really interesting opportunities are related to the IRA in the US. So we're seeing, for example, waste management, which benefits from biogas tax credits. We're seeing Train Technologies, where there's real incentives and support for heat pump technology and other energy efficiency kind of products and services. And then within Europe, we're seeing energy efficiency names like Schneider Electric, where their energy management business is really doing well in these sorts of areas. And we can look more broadly. We're seeing microfinance, we're seeing lending in India and Indonesia, really driving businesses like HDFC Bank, Bank Rakyat. And so there's a real broad kind of way to kind of play these structural growth themes that really have less to do with the macro. And I think that's where investors need to be if they're going to be in equities. They need to look at those businesses that have control of their own destiny, have the ability to price the products and services they produce, and grow through a macro slowdown.
Stephanie, thank you so much for joining us. Stephanie Niven there at 91 Portfolio Manager. Now, we did get some breaking news about 8 minutes ago, actually, from the IEA on how they're expecting oil demand to grow, and they're expecting growth to slow dramatically. Now, they understand, or they think, through their analysis, this is the International Energy Agency, that global oil demand growth will taper off over the next few years as high prices and Russia's invasion of Ukraine actually speed up the transition away from fossil fuels. That is not the view of Shell, as we heard this morning. On the contrary, Shell is boosting dividend as it pivots back to oil and gas. So there's an interesting juxtaposition there on various beliefs. Now, coming up, hydrogen is seen by many as the ultimate alternative fuel source, but so far it's actually failed to ignite mass market interest. So we'll look at where the technology stands and its chances of taking off in the future. That's next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition on Francine Lacroix here in London. Now, we're getting a lot of breaking news, actually. UBS on the back of finally, I would say it was in record time, but actually sealing the deal with Credit Suisse on Monday. This was regulatory things that just had to get done before they get into the nitty-gritty of integrating the two banks. Is coming up with some news. UBS has amassed around 1,200 private bankers in Asia as the region has been spared a lot of the cuts. We know also that Iqbal Khan, the global wealth chief of UBS, had been betting on Asia, and that will continue to generate lucrative clients. One of the first stories that we reported on the back of the takeover of Credit Suisse by UBS is that he traveled to Asia to really try and get his top performers to stick with them. So UBS now planning to take on the bulk of Credit Suisse Asia private bankers. So it seems that their jobs are safe if they want to stay there. Now, let's get on to energy. And hydrogen has been billed by some as an alternative fuel that, if properly harnessed, can help slash global emissions and hit net zero targets. Automakers, including Hyundai and Toyota, have put their weight behind hydrogen fuel cell vehicles in recent years. Sales, though, have disappointed, raising questions about its viability as a mass market alternative fuel source. Now, we're joined by the TES Chief Executive, Marco Alfred, and Enapter co-founder, Vaitea Cohen, for a robust conversation on what happens next. So, Vaitea, Marco, thank you so much for joining us. Marco, you left, right, a big energy company in Italy to really focus on hydrogen. Are you, first of all, disappointed that it hasn't been adopted mass market? Is it a problem with technology or perception?
So hydrogen is not a mass market product. Hydrogen has to replace the heavy industry fuels, the shipping fuels, the aviation fuels. Europe has banned fossil fuels starting in 2035. We'll accept e-fuels. So every time you read the word e-fuel, that's hydrogen. So hydrogen, there's now consensus that hydrogen is going to be big. Hydrogen is going to be about 25% of the global energy mix down the line, and it's getting cheaper and cheaper. So we just have to wait and go through the hurdles and the obstacles to getting there.
Yeah, but Vaitea, you have to believe in it, because even it needs to reach, I guess, critical mass before you really get proper investments in it.
Sure. I mean, I think we are absolutely believing it right now. We're scaling up our facilities at Enapter. We've broken record actually from Pisa, shipping 3 megawatts of electrolysis in Q4. We've built now a fully off-grid electrolyzer factory. We have more than 300 million in demand pipeline for a megawatt system. So we see the demand coming and we absolutely believe in it.
But what's your order book looking like? And again, I don't know if there's a tad of disappointment that, it could always be better. And I don't know whether you were expecting it to go quicker than it is right now.
It can indeed go always quicker, right? But I think when we look at lessons that we learned from solar, right, it is about proving a technology that works, that is reliable, that is easy to service, and that costs are declining. And this is a lesson that we've learned with Enapter, deploying more units than any of our competitors, and that we're seeing that we're proving that our electrolyzers are working, they're out in the field, and that actually from an order book perspective, it's looking like a healthy one as well, from kilowatt and megawatt demand.
Marco, when you look at some of the money and the allocated capital and actually growing this business, even if it's not mass market, you probably need companies to start making bigger investments in terms of final capital allocation. When will that happen?
So the first very large project that we were happy to contribute to is NEOM in Saudi Arabia, $8.5 billion, 26 banks, I think 70% debt finance. That's producing green ammonia. Yeah. That's the first. There will be more. We're working on several projects similar to that. We recently announced a joint venture with Total, 50-50 project, to build a $3 billion facility in Texas. So for these projects to happen, they have to be bankable. That's the key word. For a project to be bankable, you need three things. You need the technology that Enapter is working on, and many others are. You need the clients to do the offtakes, and you need the banks to be willing to finance it. It sounds easy, but it's not so easy. And the real stumbling block is the offtake. How do you get customers to sign on the long term when there's so much uncertainty still on the subsidies? The IRA has been announced, but the details haven't been fully defined. The UK government is thinking about its own way to subsidize this, and in Europe, there's a lot of discussions. China is the leading market right now. That's where the bigger projects are happening.
Marco, is there going to be escape velocity at some point? So Bloomberg dedicates a lot of their reporters to try and crunch through the data. Yeah. And you have hundreds of hydrogen projects that have been floated by governments that have been applauded, but looking at the data, only 7% of those have the financing to start construction. So what needs to happen for that to change?
So they need to become bankable, to your point, and to the Bloomberg analysis point. And to be bankable, you need customers. And so the real problem is if you deliver a ship full of hydrogen somewhere. People don't know what to do it because the infrastructure is not there. So there's a big chicken and egg problem. You build a hydrogen pipeline. I've been advocating for many years to build hydrogen pipelines. Now I'm shifting to say, because it's going to be so hard, and because the world went from being very rich 6 months ago with low interest rates to being a lot poorer in government language, we now need to think of ways to make hydrogen easier to adopt. So we need to convert hydrogen into something that people can start using today, whether it's e-diesel, e-kerosene for aviation fuel, or what we do in tests, which is ENG. We convert hydrogen to natural gas. That way you don't need any infrastructure. And that's the only way we can break this chicken and egg and get the projects to scale up. But there's a consensus now that hydrogen will cost below $1 a kilo, which is cheaper than fossil gas this decade if we get our act together. There's now consensus in the US, in India, in China, in Europe.
Yeah, and this is if we get our act together. When you look at hydrogen, when can it really start credibly replacing natural gas?
Yeah, I mean, I think in Europe we don't lack ambition. We lack pragmatism and implementation. So at Enapter, at least, that when we look at our megawatt-size system, we are reaching this below 2 kilograms per euro with cheap electricity. So I think it is a question of speed, scale, and implementation. And so we are going as quick as we can to be able to reach this within this decade.
Is a lot of the money going to the US? Is there a worry that actually Europe will lose out because the US is implementing the Inflation Reduction Act with its own problems, right?
There's a big misconception. So the way the IRA subsidy is built and support is built is that you can build a project in the US, like we're going to do with Total, and you can bring the molecules made in the USA to Europe at a discounted price compared to the full cost. So the subsidy allows you to export, which is good news for Europe. Europe and the UK should focus on getting as much of that hydrogen into Europe as soon as possible. Then the other thing is that the subsidy is designed to incentivize local manufacturing. And so that's where governments need to collaborate more, because we should scale up the manufacturing. Because if we scale up the manufacturing, we accelerate the cost reduction. It took 15 years to get solar energy from 800 to 10 euros a megawatt hour. 800 to 10, 15 years. We can do the same with hydrogen and get it to below $1 a kilo if we speed up the scaling up of these factories. That's all we need to do, because the sun is there, the wind is there. And by converting hydrogen into fuels that you can put into trucks, into ships, into planes and factories today, we've kind of solved this chicken and egg dilemma with the infrastructure.
What's some of your biggest concerns? I know you're extremely ambitious in how much you're trying to grow and invest. Is it coming together?
It is coming together. I mean, I think one of the biggest bottleneck is policy and not technology, right? So all we can do is actually work on our technology, prove that it is reliable, prove that the orders are there, that we have the customers. So I think it's about really setting out the right framework, that there are faster zoning and permitting laws, that we are not just waiting for projects to go online, because the demand is there, our projects are ready to go live, and so are we.
Marco, I mean, the other thing that really caught my eye, and I was speaking to a big private bank that was saying, like, look, they're pushing everything on sustainability, not really because they believe in it, but just because the economics of it makes sense, that we're in a transition, it will accelerate, and we're not realizing yet. And then you wake up this morning and you read the headline that Shell is pivoting back to oil and gas. What does that mean for money, again, and capital going into renewables? So
once a project is bankable, as I said, the money flows, as we've shown with NEOM and many other projects. So the key is to produce hydrogen in a way that customers can buy it today, because if we don't have a customer investment decision, that's more important to me than the private banks or private equity or sovereign wealth funds, because the customer's balance sheet ultimately is what's going to finance this, like the gas industry has always operated for the last 50 years. So you need to create a product through hydrogen that customers can sign up to. Then the money will flow. But I think, to your point, there is a little bit of a hype. People probably were expecting it to happen faster. Yeah. I've been writing about this for 4 or 5 years. And 4 years ago, I thought it would happen in 15 years. Now I think we've gained 5 to 7 years through the IRA, through the speeding up of this in China. Japan is now committing to move from LNG to ENG, which is what we do, which is electric natural gas.
But a chief executive saying, like, look, they want to pivot back because they don't see peak oil. Does it change perception, capital?
I think the peak oil is probably moving further out. Right. And the oil is generating a lot of cash for these companies. That's all cash that can be redeployed in the energy transition. And I was in the Kingdom of Saudi Arabia. I was in the UAE talking to the leadership there, to the energy ministers. They really see hydrogen as the new oil. and they're going to be investing and deploying billions. And whilst Europe and the US fiscally are in a poorer situation, these countries have all the capital to turn their deserts into hubs of hydrogen production.
All right, thank you both for joining us. Marco and Vaitea there at TES, Chief Executive Marco Alvera, and NAFTA co-founder Vaitea Kowan. Now we'll have plenty more, of course, on energy. We'll also talk inflation. Markets have priced a pause from the Fed for June, so we'll take a look next at the predictions for the Fed's rate path beyond their decision. That's next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, investors underpricing the possibility that the Federal Reserve will telegraph a higher peak rate with its new dot plot this week. Now, we love the dot plot. Love it or hate it. It's the one thing that you won't miss. Now, the Fed, a lot of people are saying it will have to revise its dot plot to acknowledge that it isn't done with the efforts to quell inflation. But actually, if you look at how interest rate traders are positioned, they're not quite positioned for the Fed to keep tightening, with meeting date swaps assigning only about a 70% chance when you look at the data of an increase in July. No hikes beyond that. Now, given that the Fed really has adopted a slowly approach to guiding the markets towards a higher and higher benchmark rate, the median may well show that the peak rate is 5.4%. So we'll look at the dot plot. We'll also look at what all of that inflation and jobs data means for the UK. Up next, we speak to a former Chancellor, Mr. Zahawi. We ask him about politics in the UK and what it means for the Conservative Party. The Fed set to hold rates for the first time in 15 months as inflation continues to cool. European stocks mostly higher, with US futures mixed. The UK economy bounces back in April to pre-pandemic levels, fueled by growth in services. Stubborn inflation hangs over sentiment. We'll be speaking shortly with the former Chancellor Nadhim Zahawi. Plus, Donald Trump urges prosecutors to drop the charges against him after pleading not guilty to 37 counts pertaining to classified government documents. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Bank of England Governor Andrew Bailey says the UK jobs market is very tight, with so few available workers that employers are having to hoard labour. Now, he told the Economic Affairs Committee why he thinks inflation is taking longer to come down than expected.
I mean, we still think the rate of inflation is going to come down, but it's taking a lot longer than we expected. So again, we have to introduce, we introduced an explicit, a sense, persistence of food inflation into the forecast.
Well, UK Labour leader Keir Starmer says political turmoil in the UK is affecting Britain's reputation. He also told me his party sees an opportunity to make gains in Scotland after what he's called the Scottish National Party's implosion triggered by a probe into finances. Well, I spoke to Sir Keir Starmer at London Tech Week.
We've burnt through 3 prime ministers. We've had 4 chancellors and 4 budgets in the last 12 months. And, politically, that makes for a lot of material. It is certainly evidence of chaos. And political parties usually fight like this when they're out of office. It's very unusual to have it when they're in office. And now we've got 3 by-elections caused by just political fallout.
Well, the UK economy bounced back in April after contraction in March. That's as strong growth in the retail and creative industry sectors offset a slowdown in construction and manufacturing. However, stubborn inflation, of course, continues to hang over the economy, dampening sentiment. Well, our next guest has served as chairman of the UK Conservative Party, as education secretary, and last year as Chancellor of the Exchequer. Nadhim Zahawi, welcome to Bloomberg. I mean, what's going on with your Conservative Party? It seems like it's in shambles. It's a bit of a mess right now.
Well, look, there's been political drama before. When I was Chancellor of the Exchequer, of course, I took over from Rishi when he resigned from office and delivered the Mansion House speech and, of course, launched the next day the Financial Services and Markets Bill, which is about to receive royal assent end of this month, which will make this place, the City of London, again, the most competitive place to IPO, to come and build a business as well. So, yes, of course, we've had political drama and turmoil, but actually institutions in the United Kingdom are strong. The Prime Minister has a very clear strategy on halving inflation this year, growing the economy, and, of course, targets on the NHS, cutting those waiting lists and stopping the boats.
What's the way forward for the Conservative Party? It's very unusual to see this kind of infighting when you're in power.
The way forward is to halve inflation this year, to grow the economy, cut the deficit, of course, deal with the NHS backlog, and stop the boats. If we deliver those 5 promises, like we did with vaccine, at my time when I was vaccines minister, you earn the right to be heard in 2024, where we can return to a tax-cutting agenda at the right time. The economy is confounding the sceptics and is growing. But I think if you deliver those 5 promises, which Rishi is focused on, then I think the public will see beyond the froth, beyond the tittle-tattle, and see a Prime Minister that is actually delivering, rather than Keir Starmer talking about Scotland, yet he's about to put 200,000 Scots, mainly Scots, out of work because of his policy of no gas exploration.
So you're no stranger, of course, to some of questions and even some of the scandals, where it means that you had to step down. Are you on Team Rishi or Team Boris?
There is no team other than the government team.
What do you mean? I read the press.
I hear you, but there is a Prime Minister and a government strategy, which is 5 promises: halve inflation, grow the economy, cut the deficit, NHS waiting backlog, and stop the boats. Deliver those 5 promises. That's what your viewers want to see. They want to see inflation halved. They want to see the economy growing. It's in growth at the moment, but we need to do much better on that. And then you earn the right to be heard. In 2024, Rishi and the Chancellor will set out the tax-cutting agenda that I hope people will then vote for and we win the general election. How
do you have inflation? I don't know what that means for a government to have inflation without a recession that could be induced by the...
Well, no, actually, the way you halve inflation is financial discipline, fiscal discipline, which is why the Chancellor and all of the Cabinet are committed to making sure that we have a fair and equitable public sector pay rise that doesn't embed inflation, because embedding inflation harms the whole economy and, of course, the most vulnerable people. So the government's role is fiscal discipline. Of course, the Bank of England has monetary policy, you know that.
Right, I do know that.
And the coordination of those 2 things, the coordination of monetary policy and fiscal policy, is what will deliver that inflation coming down, because the best tax cut, actually, that you can give businesses is bring inflation down.
Yeah, it seems like a bit like of a nightmare, right, being at the Bank of England right now.
It's difficult. We've got war on our continent.
But do they have to put this country in a recession to make sure that inflation is under control?
Well, I think the important thing is that the country didn't go into recession. A lot of people said that it would, but Jeremy Hunt and the policies he put in place has meant that we haven't gone into recession. But look, it is difficult for us. There is war on this continent raging right now. We've put billions and billions into helping Ukraine and the Ukrainian brave military to defeat the illegal occupation of their country. That has a price, and the price is what we're going through in 2023, which is a spike in energy costs that led to higher everything from food prices because of fertilizer price. All that has a cost associated with it. The way you deal with it is fiscal discipline, and then you return to tax cuts.
But is it almost impossible that fiscal discipline actually makes up for all the external shocks that you're talking about? Or are we talking about a catch-22?
Well, no one said 2023 was going to be easy. It's not easy anywhere in the world. You look at Europe, Germany, elsewhere around the world. None of these decisions are easy. When I was in the Treasury, we had to make difficult calls. We put in an energy package to help people just get through the energy price shock. That would have been about 150 billion if gas prices had remained high. Now, luckily, the gas prices have come down, so it doesn't need to be that large. But nevertheless, we put in 28 billion of help into households and businesses. That's the right thing to do. It's a difficult time on the European continent, no doubt. And the sooner that Mr. Putin learns that he has to leave Ukraine, the better.
Given the cost of living crisis, is now really the time to abolish inheritance tax?
Well, I think it's an inefficient tax. My role at the Adam Smith Institute is to fight for the ideas of the future. It's an inefficient tax. It's a tax that leads to, I think, distortions in investment decisions. So when you're getting to that stage where you're thinking about inheritance, you might decide to spend everything you've made and you've put into assets because you think, well, I can't leave it for my children or grandchildren. That's bad for the economy. So I think actually making those arguments and at the right time being able to demonstrate that you know how to pay for it, then you begin to deliver that tax-cutting agenda. My role at the moment as the patron of the Adam Institute is to be able to make those arguments for those ideas. It's up to the Chancellor then to look at those seriously.
But again, since you've been, part of the Conservative Party for such a long time, does this backfire? Actually, when you look at the polls and how badly the Tories are performing right now, is it something else that would make people turn to Labour? I
don't believe. Look, politics is the battle for ideas, and actually, if you look at the think tanks on the right of centre, are the ones that are coming up with the big ideas. Universal credit was an idea by Ian Duncan Smith and the Centre for Social Justice, a brilliant piece of work that has transformed the way we do welfare in our country in a fair and equitable way and getting people back into work rather than people being trapped in a welfare trap. Those came out of think tanks like Adam Smith and others. So it's a battle for ideas. That's good for the nation. That's good for your viewers to hear Conservatives having the energy to come out with ideas.
Our viewers also want to know about the House of Lords Appointments Commission. Who's telling the truth, Sunak or Johnson?
Well, look, I haven't really been following this story at all because I've been focused on the work on the Adam Smith Institute and what we're doing here today with you at Bloomberg on AI with the Minister for AI who was appointed in 2017 in the UAE, Omar Al-Ulama, a great minister who's here talking to us about their AI strategy. So ultimately, all this stuff, I think we will move on from. What the government's focused on is those 5 promises: halving inflation, remember them?
Okay, well,
growing the economy,
I do remember them.
Cutting the deficit,
my brain.
NHS waiting lists, and of course stopping the base.
All right, let's see what can be done. Nadhim Zahawi, thank you so much for joining us, former UK Chancellor there. Now, coming up, the show goes on. Donald Trump returns to campaigning only hours after his arraignment in federal court. More on that next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Donald Trump has urged prosecutors to drop federal charges against him as he continues to campaign despite being charged in a Florida court. Now, the former president earlier pleaded not guilty to all 37 counts in the indictment, which alleges he willfully retained top-secret documents and conspired to obstruct efforts to recover them. Let's bring in Bloomberg's Bruce Einhorn in Hong Kong. So, Bruce, what else happened at the hearing?
So, Francine, this was a hearing before a magistrate judge who allowed the former president to remain free until the trial starts. He also did not impose any travel restrictions or confiscate the former president's passport. He did instruct former President Trump not to discuss the case with any witnesses. That prompted some pushback from his attorneys, who complained that those instructions were overly broad. In the end, the prosecutors agreed to provide Trump's team with a list of people with whom he should not be talking about the case. As far as what comes next, the magistrate judge did not say when there would be a first trial date with the trial judge. Of course, in the U.S. system, the magistrate judge handles it at this level, but does not continue hearing the case there as a separate federal trial judge for that. We don't know when that will start, Francine.
So how did Trump actually respond after it ended?
Well, he continued with his criticism of the special prosecutor, Jack Smith. He continued with his criticism of President Joe Biden, saying that this is a weaponization of the justice system. He did try out what I think is a new argument here, saying that this was simply a matter of him just not having the time to go through all his boxes. He said he's very busy and just didn't get around to going through all the boxes to return all the classified documents. Of course, the prosecution says that they provided him ample time, that he willfully took the documents, refused to return them, and conspired to obstruct efforts to get them back. What comes next? Again, we are now just going to have to wait and see when the trial date starts. Meanwhile, the former president does face some other jeopardy. Of course, there's the case in New York involving the alleged hush money payments to the adult film star. Special counsel Jack Smith is continuing his investigation into the events surrounding January 6th. The district attorney in Fulton County, Georgia, is also looking into Trump's efforts to interfere with the election there. So many more potential indictments ahead.
All right, thank you so much, Bruce Einhorn, there for us on the latest twists and turns. Now, some European banks could be facing a painful process. That's after the ECB will make lenders repay about €500 billion in cheap pandemic-era loans in one go. It will test the resilience of the continent's banking industry, and Italy looks particularly vulnerable. Now, joining us now is Bloomberg's Jana Rando in Frankfurt, of course, who leads some of our ECB coverage. Jana, always good to speak to you. So when you look at who's vulnerable, is it the small Italian banks, and would you bundle Greek banks with it?
Yes, so we are going to see a massive repayment of those loans at the end of the month, and indeed Italy looks like the one place to watch, and that's just because the amounts do exceed what Italian banks have deposited at the ECB in the past. So that is one indication. Yes.
I think we're having a little bit, we're hearing in like Dolby Stereo, 3 times removed from Sweden, so we'll fix the audio because this is too important conversation not to fix the audio for, and we'll get back to you. Apologies for that, Jana Rando in Frankfurt. Now, we'll get back to Jan, of course. Also coming up, could there be a common currency for Africa? We discussed that hot topic coming out of the Bloomberg New Economy Gateway Africa Forum, so we're live in Marrakesh as well. This is Bloomberg.
This cost of currency convertibility is a constraint to trade in Africa, and so we don't have a common currency yet. There is an objective to have a common currency, but in the meantime, we have introduced a tool that actually is a step in that direction, and that is payments for trade based on a single platform for trade in Africa.
That was Vumele Kelemene, the Secretary General of the African Continental Free Trade Area. Now, the idea of a common currency for African nations has been a key talking point at the Bloomberg New Economy Gateway Africa Forum. Let's speak to Jennifer Zabazaja, our Africa correspondent at the conference in Marrakesh. Jen, thank you for joining us. Great work on the ground. So tell us more about this proposal.
Yeah, Fran, I mean, when we think about it, when we look at the continent of Africa, there's about 42 currencies. And so what Wamkele Mele was really trying to stress to us is that the fact that there are so many currencies, any sort of cross-border payments at this point in time is really creating a hindrance for any sort of progress, especially economies that are already struggling with poverty and inequality. And so what he was saying there was that there's been a lot of discussion around potentially establishing a common currency that will get away from some of the biggest expenses that countries are currently having to deal with in terms of trade. And one stat that he pointed out to us that was really fascinating, African countries are losing about $5 billion annually just because of currency convertibility. So if this common currency were to be established, it could cut down on some of those costs and actually make this trading bloc, which is predicted to be the biggest in the world if and when it's implemented, a real competitor in the global economy, but still a long way to go. At this point in time, he was talking about the digital payment system that they have established and really touting a lot of the trade pacts that have been established, including with Uganda and Algeria and others. So a lot to pay attention to there as it pertains to the AFCFTA.
And Jen, you also spoke to billionaire Andrew Forrest, founder of Fortescue Metals Group. So what did he say?
Yeah, I mean, as we know, Andrew Forrest has been a champion of green energy across the world. But really, the fascinating thing about him being here in Morocco is really how ambitious and bullish he is about the potential for this region. Take a listen to what he told us when we asked him specifically about why he is betting big on Africa.
For those companies and those governments who are not listening, particularly to the people of North Africa, who know this is their shot, this is their time to be supported, this should be their projects. Let's get in behind North Africa, let's get in behind Africa, let's give this beautiful continent its shot and its green.
Yeah, so friend, that was just part of what Andrew was telling us. And he really said that he is himself seeing a lot of the leadership in countries like Morocco and Gabon and Kenya and Egypt really step up and approach Fortescue for their own green success that they've had. But he thinks that there are still a number of companies and international players that are getting in the way of Africa really being a leader in this space, not just for the continent, not just for the climate change issues that they've dealt with, but also potentially for Europe. So he was really trying to double down on the fact that people need to let Africa step into this green revolution and establish their own green economies going forward.
All right, Jen, thank you so much. Jen Frizabazaja there with the very latest, of course, from our great event in Marrakesh. Now, let's return to a story we told you a little bit about earlier. Some European banks could be facing a painful process. That's after the ECB will make lenders repay about €500 billion in cheap pandemic-era loans in one go. And joining us now, we fixed the audio. She's raring to go. Jana Randau in Frankfurt. Jana, how problematic is it for the smaller banks?
It is certainly a challenge, and that has to do with the fact that if you look at Italy specifically, that Italian banks currently have less money deposited, less cash deposited at the ECB than they have to repay at the end of the month, and that tells you that something needs to be fixed, and that's what the attention is on at the moment. So that is a problem for Italy. In Greece, we have about the same amount of cash deposited as is due for repayment. Of course, that's only aggregate figures, so you don't know what's hiding underneath, which institutions, which banks might have a challenge there. But let me also say that it's certainly something that's fixable, right? Banks have many options to raise that money, that funding that's necessary. Not least because there is still a lot of excess liquidity out there. So we're looking at about 4 trillion of excess cash sloshing around the financial system at this point in time. Repayments are just under $500 billion. So certainly a challenge, but at least what we heard from the ECB so far, they're looking at this obviously, but we haven't seen any indication that the ECB sees any need to step in and offer additional operations, to offer longer-term facilities, replacing some of that cash. So there is, they're looking at this, and from what we hear, there is no greater sense of alarm at this point in time. And obviously, we're going to hear from the president later this week on Thursday, tomorrow actually. So that's definitely something she has to answer. Yes.
Yeah, I was going to say very quickly, we're running a little bit out of time, but what's the worst case scenario right now?
Well, the worst case scenario is that banks struggle, that banks will need to return to the ECB's standing facilities. They have weekly and 3 months operations on offer at all times. And of course, if you are as a bank forced to tap those, money is available there, so it's not a problem of getting it. But it could be a stigma that some, there will be some finger pointing if banks cannot secure funds in the repo market, for example. But at this point in time, we're hopeful that everything will go right.
Jana, thank you so much. Jana Randau there in Frankfurt. Now, coming up, we'll have plenty more Bloomberg Surveillance early edition. Of course, it's Fed Day, so happy Wednesday, everyone. This is Bloomberg.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York and 5 p.m. in Hong Kong. Our top stories today. It's the countdown to the Fed's decision. Markets bet on Chair Powell to deliver a pause in rate hikes as data suggests inflation is slowing down. The UK economy bounces back. The latest GDP data showed a rebound in April after a decline in the previous month, with the service sector driving gains. And Donald Trump fights back, the former president urging prosecutors to drop the legal charges against him in a speech following his Miami court appearance. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And Kriti, modest gains across European equity markets. We are waiting, of course, for the Fed. We've got the CPI data. We'll move on quickly to what that means for the Federal Reserve.
Yeah, modest gains in the U.S. session as well, and I think you're starting to see a lot of that come, not specifically around the Federal Reserve, but I have to say some of the micro stories in the absence of that macro narrative that we are still waiting for. Remember, the market consensus at the moment is that we are going to see a Federal Reserve that actually pauses today, and that is going to be crucial. Again, as we look at what happens to the bond market, we're going to get to that in a moment, but the real outperformance you're seeing is in those tech shares. The NASDAQ 100 futures higher by 0.2%. The bond market, on the other hand, seeing a very small bid, especially on the front end of the curve. We're looking at 464 on the 2-year yield. But for our radio audience, bear with me because I also put the 10-year yield up here. And this is important when we talk about the spread between the 2s and 10s curve. We're looking at about -85 around that level. And that's significant as we talk again about this curve kind of going on its way to uninverting. And what does that tell you about whether or not the Federal Reserve needs to be cutting? How is the market thinking about it? That's something we're going to be digesting throughout this show. The 10-year yield, nevertheless, at about 380 on that note. To me, what's interesting, though, is going to be the FX story. We are seeing broad weakness in the dollar this morning, but remember, we are also on policy watch from China, from the BOJ, and of course from the ECB as well. But to me, I think the biggest currency pair to watch right now is dollar yuan, specifically because we did get that small policy cut yesterday as well. Small, but surprising nonetheless. So really to kind of firm up that thinking, a lot of attention being put on the MLF decision on Thursday, which again is going to really impact just how much weaker, Anna, the Chinese yuan gets.
Yeah, absolutely. How weak will the data be when we get it from China tomorrow, and what will the policy response be? Certainly very live questions. This is the European picture then, Kriti, looking pretty positive across European equity markets. Modest gains coming through in London, better gains coming through in Paris, in Germany, certainly over in Italy, where we see bank stocks doing pretty well, up by 1.25% on the FTSE MIB. Let's dive beneath the surface and have a look at some of the other dynamics, because we've dealt with a lot of UK data over the last couple of days. We had a really tight labour market once again being flagged in the labour market data yesterday. We got an in-line, back to pre-pandemic levels story around GDP this morning. So all of that data playing in to the UK assets and the UK 2-year yield. I put that in because yesterday we saw outsized moves higher in UK yields across the gilt curve. We saw bigger moves than we saw in other parts of Europe, and it really was factoring in just how many hikes we're going to get from the Bank of England, given how persistently tight the labour market remains. Well, today things look a little bit different. We see those yields coming down a little bit, but again, in contrast to the rest of Europe. On that labour market story in the UK, really interesting to look at this mid-cap stock, Robert Walters. It's a recruitment business. It puts people in jobs, and they are talking very negatively about what they're seeing in the market. So does this give us micro clues as to the macro that we've been expecting, but has to this point remained elusive? That is a loosening of the UK labour market story. That's stock down by 12.7% as they talk about candidates being more nervous about moving jobs and it taking longer to get those hiring processes through. This is Shell, not moving much, but they have an investor day and they've said that they're going to reduce capex and increase dividend. The dividend increase wasn't as much as many in the market expected, but it was the plan around capex apparently that sent the share higher this morning. And Brent crude up by 1%. We've heard from OPEC, we've heard from the IEA around the supply and the demand stories that they expect to see unfolding on oil. We've also, in our own reporting, been talking about what the US government is doing with its strategic petroleum reserve. So a lot to watch there at $75 on Brent.
Certainly something we're going to be keeping an eye on, but let's get a little bit more analysis on that European story, specifically, Anna, the UK data that you mentioned showing that the economy bounced back in April. Joining us now to break it all down, Bloomberg Economics' senior UK economist Dan Hansen joins the program. Dan, one of the major topics at the IMF spring meetings this year was just how long the recovery in the UK is going to take, and some people said it would take years. Is today's data a little bit of optimism amid a lot of gloom when it comes to the UK?
Yeah, I mean, I think it's really interesting what we've had today, and particularly what we've had over the past 6 months. I mean, the UK economy has done far better than anyone had been expecting, say, 6 months ago, where you had all this talk of a 1990-style recession, a peak-to-trough fall in GDP of about 2 to 3%. so far, the economy hasn't fallen into recession. We've had broad stagnation. Now, of course, that isn't a great story, but compared to what we were expecting, as I say, 6 months ago, it is significantly better. Of course, the flip side of all of this, and Anna was mentioning it there, is that we've still got a very tight labour market in the UK because demand for labour is holding up. And that's feeding through to the inflation story, which, of course, gives the Bank of England ever-increasing headaches.
Yes, absolutely. Good morning, Suzanne. Let's go on to that, what this means, because as you say, as we've been discussing, tight labour markets, inflation above 8%. Where does all of this leave the Bank of England?
Well, I think the combination of April CPI data, yesterday's labour market data, and to some extent what we've had today, a June hike looks nailed on, say next week. We think they'll hike again in August. The market, of course, is pricing hikes all the way to December and a peak rate of 5.75 in February. But I think the thing here for the Bank of England is that it has to recognise that it's going to have to push harder, quite significantly harder, on the UK economy.
So we could get a 50 at some point?
I don't think they'll go for 50 simply because I think that will look like they're panicking and they've lost control. Rates are already very high. There's going to be a lag in terms of the impact coming through. But I think you can debate where the peak rate might be, but I think the really key point is that rates are going to have to stay at that peak rate for a long time to push the economy down and bring inflation down.
Certainly something we're going to be watching, and the ripple effects around policy for the rest of the world. Dan Hansen of Bloomberg Economics, thank you as always. And sticking with the economic story, except perhaps this time on this side of the Atlantic, the latest U.S. inflation data supporting the case for the Federal Reserve to pause their run of rate hikes. Here's what some of our guests had to say looking ahead to that decision.
We got a strong core print.
It was a good report.
This is a step in the right direction.
Inflation is coming down. The Fed has to be pretty happy with these numbers.
It takes away some of the pressure for the Fed.
That should buy them more time to keep watching the data.
I would vote for wait and watch.
It doesn't look like they're going to need to hike this week.
The skip is priced in. Definitely a skip.
It is sort of a grudging skip, if you will.
I think it's a skip at this point, and I think it's going to turn into a pause.
Turns into a pause after that.
They're likely to go one more time in July.
It doesn't look like they're going to need to hike in July.
They're going to be communicate that they have to be flexible, that all options are still on the table.
So a variety of takes on Wall Street. The equity market, on the other hand, cheering the inline U.S. CPI print that we got yesterday. The S&P ending the session pretty solidly in the green. Then you look at the bond market, did not handle it just as well. Yields jumping as the expectation for Fed cuts later in the year priced out of the market. Let's get to our markets reporter, Valerie Teitel in London. Valerie, walk us through the price action yesterday. What might we expect today?
The price action yesterday was quite bizarre. It made sense in the equity market, almost a sigh of relief. We don't get any last-minute change of communication from the Fed ahead of today. But the bond market really did not like this print. Yesterday, I had to do a double take. 5-year yields at one point were higher by 13 basis points. Now, a lot of eyebrows were raised as to why this was. Some saying that the bond market was maybe a bit rejecting the idea of a pause, saying if the Fed's going to pause tomorrow, I'm going to expect more hikes later. Or maybe all of a sudden we just woke up to the idea that higher for longer really is a real phenomenon. We had all those cuts for this year completely priced out. If you look at what happened in the November and December pricing, we're no longer pricing cuts out to the end of last year. Perhaps this is just what a bond bear market looks like, and we get sell-offs like this. You know, we've not been in a bond bear market for the last 40 years. Maybe we should just get used to sell-offs rather than rallies. But it made me do a double take on make sure I didn't miss anything from the U.S. inflation print. Broadly came in line. The core CPI year on year came in slightly hot, but that was almost completely dismissed. It was down to an anomaly in used cars, which we know is going to fade. But the core CPI came bang on month. You just have to raise an eyebrow. Why was it this print that made the market believe that higher for longer is here?
Yeah, really interesting dynamics then in bond markets yesterday, Valerie. Now onto the Fed's decision. What is the big thing that you're going to be watching for?
Look, now that the pause is a near certainty, it's going to be all about the dots today that will be released as well as with the decision at 2 p.m. Now, if they match the March dots, that essentially is telling us that there are no more hikes in the cards, that would be a dovish reaction. But the thing to watch out for is, do they shift higher? Do they shift higher by 25 basis points, showing they're one more hike for the rest of the year? Or perhaps the more hawkish outcome, they shift higher by 2 more hikes. rates. The other possibilities to watch, or is the dispersion going to widen? We know that there's been some bit of battling between the Hawks and the Doves just in the last month, which is really the first time this cycle we've seen some disagreement. Perhaps, and just perhaps, they keep the dots very similar, but focus on the 2024 dots, maybe shift those higher in a bid to say we're at the terminal rate, but we intend to stay at this terminal rate for a bit longer than you expect.
A lot to digest there, and you can already see a little bit of game theory being played out. Bloomberg's Valerie Teitel is always walking us through what we might expect in just T-minus about 9 hours over in Washington, D.C. I want to stick with the D.C. story and switch a little bit to politics here. Donald Trump pleaded not guilty to federal charges on mishandling classified materials. Trump insisted on his innocence and urged prosecutors to drop the case. He flew to New York following his court appearance in Miami and gave speech to a room full of supporters at his Bedminster Golf Resort in New Jersey last night.
The seal is broken by what they've done. They should never have done this. This was an unwritten rule. You just don't, unless it's really bad.
Joining us now, Bloomberg's Rosalind Matheson. Roz, a lot to digest when it comes to what the former president's implications are for the 2024 bid, but walk us through the takeaways here from the legality perspective, but also just in terms of what his response was and the kind of support it drummed up.
Well, what we're seeing is he's starting to lay out his arguments for whatever time he does end up in court on this, and basically saying that he's been singled out for unfair treatment when others have also, of course, found that they've had classified documents in their personal space after they've been president, namely Joe Biden. He's saying, why is he the one who's been charged in this when others have not? Of course, Donald Trump has accused others of bad behaviour himself previously, including using personal email servers. So he's laying out some of his arguments here, using language more commonly associated with Pearl Harbor. This day, he said, will go down in infamy, the day he pitched up in court yesterday. It's going to be a long-running process. There's no date set for when he now has to appear before a South Florida district court judge. The judge is going to hear all of this. He's free to travel, free to do what he wants in the meantime. And so this could go for quite some months and run really heavily into the US election calendar. Of course, we've got the president election coming up in the latter part of 2024. This legal case could still be going on then.
Okay, and let's think about what this means for the broader US political scene then, Roz, and the race for next year, or rather the Republican race to get there.
Well, that's right, and it's a really crowded field already on the Republican side. Many candidates jostling to be named. We'll get into the sort of the primary season before too long, and that crowd will obviously start to narrow. The question is, how do some of those other candidates potentially maximise this moment? Trump obviously is seeking to use it to rally his base, his key supporters. He's giving those speeches to people who've been his long-term supporters, but can he really retain the moderate Republican base at the same time, or is it just going to be that core bunch who've supported him all along? He's trying to raise more money. He is in front in polls. Of course, he's got the advantage here, but can he keep it through the many months ahead? Some of those candidates may move to try and peel those moderate Republicans away from him, and they're really the ones who are going to matter come Election Day.
Okay, Roz, thanks very much. Rosalind Matheson joining us there with the latest on US politics. Coming up, we'll be back to the markets. We'll be talking FX with FX strategist Sonia Martin of DZ Bank. We'll also speak to Arend, Global Chief Economist at UBS. What did he make of the link between CPI, or lack of it, and the Fed's decision later on today? We will get to that analysis shortly. And we go to the Bloomberg New Economy Gateway Africa Forum. That's taking place in Morocco. We'll speak to the Visa Executive Chairman, Alfred Kelly. That conversation later this hour. And happening right now, Bloomberg's Jennifer Sabasaja is speaking with the founder and executive chairman of EcoNet Group, a telecommunications company, at that same event, the Bloomberg New Economy Gateway Africa. You can continue to watch that conversation on Live Go on the Bloomberg terminal. This is Bloomberg.
Here in Morocco? Yeah, we're going to build some data centers here too. So we are building a lot of high capacity.
It is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, it's decision day. The Federal Reserve looking to have yet their other decision announced in less than 9 hours. Now, what does this mean for the markets here? We're like a potential positive equity reaction, a potential positive bond reaction, just given that the market has been guided to believe that they are going to pause, see where the data takes them, and then reconsider a potential hike at another point this summer. But what does that mean for the FX story? And I think positioning is really crucial to talk about. For our radio audience, stick with me. We like to revisit this chart often on the show. It really shows the dollar positioning that you see from a lot of these kind of speculative funds. And right now you're seeing that net positioning on the dollar lose a little bit of momentum. You saw this buildup going in the last couple of months. A lot of that had to do with the debt ceiling debate, the banking turmoil. If you are worried about the global economy, you go defensive. You hop into U.S. assets, and that includes the dollar. But that is starting to lose a little bit of its charm, especially as we talk about potential cuts being priced into the market or priced out for that matter, as well as the Federal Reserve ending its tightening cycle. Again, potentially anything can happen this summer. Let's bring in a true expert at where you go with the greenback. Joining us now, Sonia Martin, head of FX and monetary policy research over at DZ Bank. Sonia, thank you as always for joining the program. Talk to us a little bit about the dollar story here. What is driving that trade?
Well, as you said, I mean, there's a lot going on at the moment, and the main focus obviously is on the Fed decision. You discussed it early on in the program. The market is looking for the Fed to pause at this meeting, but there are a lot of question marks about the next meeting before the end of the summer. There's some speculation that the Fed may have to hike again. The thing is, at this point, I think, we are talking about the potentially last rate hike. It's sort of the insurance rate hike, if they did hike again, the last one in the cycle. I don't think anyone really expects the Fed to continue hiking, in the autumn. So to be honest, I'm not quite sure if I feel that this last rate hike, whether it comes or not, is really the deciding factor. And I think when you look at the Fed today, they would have to be, I think, very, very hawkish in order for the dollar to actually benefit from this meeting today.
Sonia, good morning. If we get the pause from the Fed then, it's been a long time coming, hasn't it? We're a long way off our highs on the dollar from October 22, when the market first started to think about what would happen if the Fed paused or indeed some kind of pivot. What is the trajectory for the dollar from here then?
I think we're still looking at a weaker dollar. I mean, not dramatic, because let's face it, things aren't exactly looking bright and sparkly on this side of the Atlantic. So, this is not a very aggressive view, but we're looking for euro dollar to rise up towards the 115 next year. We've been quite close to this, but obviously at this point below 110. But the main driver behind the story really is that the Fed is done hiking. It will begin to cut rates next year, early next year. And also, let's not forget that while the economy is looking surprisingly resilient so far, if you look at the lead indicators, it does show signs of weakness. And that is probably going to come, really into the foreground as we move into the autumn of this year. And I think that is going to put some pressure on the US dollar.
And Sonia, so you talk about 115 on euro dollar. Is that to do with interest rate differentials? Is that because the ECB keeps hiking as the Fed pauses? What drives us to 115?
I think the interest rate differential isn't the most deciding factor. I mean, it does play a role, but let's face it, the ECB will be hiking 2 more times and then they will be done as well. And of course, the Fed has already done so much more than the ECB. So that does play a role, but I think the monetary policy divergence isn't as big by itself. I think it's more the growth story at this point, because when you look at recent weeks or months even, the US data has almost consistently surprised to the upside. So people have still have recession in the back of their mind, but it's not really priced in right now. In Europe, it's the opposite, right? We have had a string of softer than expected data. So I think the turnaround in the growth story, that's going to be the main driver, because the US is going to perform more poorly and the Eurozone should be performing somewhat better.
Sonia, where does the UK fall into all of this? When you're looking at the pound, for example, these massive moves that you were starting to see, how do you square what the BOE is thinking about versus the ECB versus the Federal Reserve?
But I mean, the BOE is in a really, really tight spot at the moment. And they're really in a situation where, let's face it, the Fed has already been really high inflation, tightening of monetary policy that doesn't seem to be doing anything to dampen price pressure significantly. And then, of course, you get to this point now, and I think this is where we're at, where, the fundamental picture is still so relatively solid labor market. We saw this yesterday, which means that the Bank of England has to continue hiking rates to combat the inflationary pressures. But in doing this, they will obviously risk a fairly rapid economic turnaround to the downside in the future. So this is a really difficult time for them.
Sonia, thanks so much for your time. Sonia Martin of DZ Bank, thank you very much for joining us. For more market analysis, you can check out the Markets Live blog. MLIV Go is the function on the Bloomberg terminal. You'll find analysis of the CPI, ahead of the Fed, all that on the blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. It's the countdown to the Fed's decision. Markets betting on Chair Powell delivering a pause in rate hikes as data suggests inflation is slowing down. The UK economy, it bounces back. The latest GDP data showed a rebound in April after a decline in the previous month, with the service sector driving the gains. And Donald Trump fights back, the former president urging prosecutors to drop the legal charges against him in a speech following his Miami court appearance. I'm Krita Gupta in New York with Anna Edwards in London. Look, geopolitics at the forefront. So is the Federal Reserve, though. And I have to say, it has to be the central bank decisions that are driving the trade, not just today, but all week long. You've got the Fed today, the ECB, the BOJ, and some interesting stuff happening over at the PBOC as well.
Yeah, absolutely. Perhaps bookmarked by activity at the PBOC. We'll wait to see what we get delivered tomorrow on that front. This is the picture across European markets as we are post-CPI, pre-Fed. We are up by 0.5% on the stocks Europe 600. Real estate stocks doing pretty well today. That seems to be one of the better performing ones throughout this morning's session. Interesting to see UK assets on the move. Kriti, you talked in the headlines about that bounce back in the UK GDP story. That gives headaches, though, to the Bank of England that wants to loosen the labour market and drive inflation back down from the 8% and a higher level. This is the UK two-year yield. Not sure it's responding really to the data, but perhaps actually to yesterday's data and to the big outsized moves higher we saw in yields in yesterday's session. So yields went much higher yesterday. Today we see them come down just a touch. Were they responsible actually for dragging some of the other global bond markets around? That's an open question. Robert Walters is a recruitment business, mid-cap here in the UK. But it's interesting for us because of what it tells us perhaps about the macro picture. There is a really tight labour market here, but are we seeing some cracks emerging in the Robert Walters story? They're talking about candidates being less enthusiastic about switching jobs or less confident to do so, and it taking longer to fill those or to complete those recruitment processes. So all of that adds up to a profit warning for that business, and the stock down 14%. Shell, a little bit of a move higher there, up by 0.4%. They've got an investor day, Kriti, and they're talking about cutting back on capex, and it's that headline that seemed to please investors and got some positive response from analysts.
Certainly a story we're going to be watching, especially when it comes to the read-through into the United States. But Anna, that green on the screen you mentioned in Europe, you're seeing that in the U.S. as well, which is interesting because on Fed Day, like today, you tend to see a little bit of cautious nature to trading before the actual decision itself. Essentially, the first 2 days before the Federal Reserve decision, even the morning of, tend to be negative only for the market to rally. And the idea here simply is that that means that the Fed has then guided markets to exactly what they're thinking, so they then buy the news. That being said, you are seeing far more optimism baked into today's Fed decision. In fact, a lot of outperformance by the tech-heavy NASDAQ. The NASDAQ 100 futures higher by about 0.3%. If you're looking at the S&P 500 futures, also higher by about 0.2%. So again, seeing a little bit of green on the screen. I wouldn't call it major momentum, but a little bit of optimism, more so than we've seen on past Fed days. But the bond market, look, it all comes down to that. The two-year yield, 4.64, seeing a move about 1 basis point lower on the front end of the curve. I'm throwing the 10-year yield as well up here, 3.80 on that benchmark, also down about 1 basis point. The spread between the 2s and 10s is crucial here because we have started to make our way towards uninverting, if that's a word. And the crucial piece of that is how much of a signal is it? We're going to talk to an economist about that in just a few moments. But again, the ripple effects are crucial because if you're talking about the 2s, 10s uninverting, what does that mean for the FX space, which then brings us to the dollar? Seeing a little bit of broad weakness for the dollar here, some strength against the offshore yuan. Anna, you mentioned that we're going to see that crucial MLF decision tomorrow. What does that mean for the Chinese story and how it feeds into the U.S. story? Something we're going to keep an eye on very closely in the next few days.
Yeah, global central banks certainly in focus this week. Let's get a global chief economist perspective. Arend Kapetyn joins us from UBS. Arend, so nice to have you with us and to get your global perspective. We'll start with the Fed, though, because that's the big event of the day, of course. You're expecting some action on the dot plot, possibly the mention of a July or the indication of a July hike there. Will that be the last from the Fed?
Yeah, so all the information is going to be in the summary of economic projections. So they have very consistently since September of last year maintained the real Fed funds rate in their summary of economic projections at 1.5%. And so if today they raise the inflation forecast by about 30 basis points, you should expect the median dot to go up by about 25 basis points. That's been sort of the consistency. It's also what triggers the cuts, right? So in their forecast, when inflation goes down next year by 100 basis points, they cut by 100 basis points. So you have sort of a framework to analyze the reaction function. If today they simply lift the dots by 25 basis points and inflation by about 25 basis points, you know that nothing has changed on the reaction function. So that is the thing to watch for. If they do more than that, then obviously there's a change. Now, we don't think that's likely, but that's sort of the way we're thinking about those dots.
So a lot of focus on what happens today, what they signal for July, a lot of focus on when they start to cut, as you flagged there, Arend. I mean, what will trigger the Federal Reserve to start cutting? Will it be enough to just see inflation not at such elevated levels? Will it have to go below 2% to see the Fed cutting? Will the outcome in the economy, some weakness in the labour market or underlying recession dynamics, will that be the thing that triggers a cut?
Yeah, so the interesting thing in their own forecast, they're medians, but in their own forecast, is that you do not need inflation at 2% for them to cut, right? So if they are truly managing a real Fed funds rate towards a level of about 1.5%, then as inflation comes down, they want to avoid being overly restrictive. So this is not inconsistent with the high for longer narrative. All that needs to happen is we need to get some disinflation that goes beyond what they're expecting by the end of this year, right? And so that's basically what the TIPS market is pricing. That's what a lot of economists are forecasting. That's the first part of the reaction function. That sort of starts the cuts. We think that starts in December, but that's the first bit. The second bit, which is really, how do you get below neutral or how do you do more than the market is pricing? That requires, we think, a recession. And so we have that in the forecast, but that comes later. That is not for the first cut in December.
What does that then do to something like the Fed's credibility, though? They've been so kind of tied to the narrative that cuts are not in their future, that they're really going to go hard on inflation. I mean, I'm curious how they're even going to navigate a potential pause, if that is what they deliver today, at a time when credibility for the Federal Reserve is really in hot water. How are you thinking about that if we do end up getting a pause today or a cut by the end of the year?
Yeah, so one problem for them is I think they've tied themselves to jolts and payrolls, and obviously they're still running quite hot, and so it looks like they haven't done their job, and so hence they need to keep going. So they're a little bit trapped by that narrative. But on the inflation side, I think Powell's been quite open in the past press conferences that he's been asked the question, what if effectively the TIPS market is correct and we get much more disinflation sooner? He said, well, then we can obviously change our mind. And I think through that dot plot, they have consistently sort of laid out their framework as to being responsive to inflation coming down. Now, the other interesting thing, from the next sprint onwards, we are going to lose about half of the core inflation momentum for a whole series of months. And this is basically just the flip side of what happened in Q4 last year, that they changed all the seasonals. And so if nothing else changes in underlying inflation dynamics, then from next month onwards, we're printing 20 basis point core CPI prints rather than 40 basis point core CPI prints. They will start to accumulate that sequence of lower prints throughout the summer, and that is going to give them cover to only deliver the July hike and then sort of nothing beyond that.
Arend, we've also got an ECB meeting this week, of course, tomorrow, in fact. The market is expecting a hike and one more maybe after that as well. Away from the hiking, though, we've also got some other dynamics to watch. What do we need to know about TLTROs? So this is the cheap loans that the ECB gave to banks over recent years. What's changing there? I'm thinking about this because I see Italian bank stocks doing really well today.
Yeah, what's sort of curious? That's sort of curious because if there is going to be a problem on the TLTRO repayment, it's really in places like Italy, Greece, where the outstanding TLTRO balances exceed excess reserves. So those markets will be drained of excess reserves. You could get some fragmentation in monetary transmission, which I think the ECB can deal with later. But yeah, so the big surprise, I think, relative to what the narrative was 8 weeks ago in the middle of the banking stress, was that the expectation we had, and I think they were signaling that through their press releases, was that the bar was incredibly low to roll the TLTRO cliff, right? They've got a bit under 500 billion falling due. And so they were basically signaling, look, if the banks come and ask us and they can't find term funding, then we can do a new facility. We just roll that money. It does not look like they are going to do that, right? So the money gets repaid. We think about 600 billion gets repaid because also some of the rest that's falling due this year. And that's really a signal that, in my mind, that's a signal that they do not feel terribly concerned they're overly restrictive yet. And so while obviously they're just going to deliver the June and we think the July hike, through QT and through the TLTRO, I think they're really signaling that there's an asymmetric skew in the reaction function, that there's a risk that they need to go beyond July. And I think a lot of the banks, including us, have been highlighting that.
Arend, thank you very much. Thanks for joining. Arend Kapetyn of UBS with the Global Economic Outlook. Coming up, we go to the Bloomberg New Economy Gateway Africa Forum. That's taking place in Morocco. We'll be speaking to the Visa Executive Chairman, Alfred Kelly. This is Bloomberg.
For those companies and those governments who are not listening, particularly to the people of North Africa, who know this is their shot, this is their time to be supported, this should be their projects. Let's get in behind North Africa, let's get in behind Africa, let's give this beautiful continent its shot and its green.
Fortescue Executive Chairman Andrew Forrest there speaking with Bloomberg's Jennifer Zabasaja at the Bloomberg New Economy Gateway Africa Forum in Marrakesh, Morocco. Jennifer joins us now to bring us yet another interview from the forum. She's joined now by the Visa Executive Chairman, Alfred Kelly. Jennifer, take it away.
Yeah, Kruti, thanks so much. I'm joined here by Al Kelly, the Executive Chairman of Visa, as you mentioned. Al, thank you so much for being here. We just heard from Andrew Forrest talking about his doubling down of the commitment of Africa. Visa is also doubling down with a $1 billion commitment to transform this continent. Talk about that and why it's so important to you.
Well, Jennifer, good to be with you. I think this is one of the most exciting places in the world. And by 2050, going to be 2.5 billion people. And it has made so much progress, but yet there's so much opportunity ahead of us. And so we're looking to expand our operations here. We're looking to extend the amount of innovation we bring to the marketplace. We want to increase the collaboration that we have with so many different players who play very intricate and important roles here in Africa. Today we're announcing, as part of our investment, a new program, a Visa FinTech Accelerator, where we plan to work with 40 startups very closely, ultimately probably taking a third of them and actually investing months worth of time and putting some capital behind them. And we will do this for the next 5 years to try to help bring more players into the ecosystem that will help Africa grow.
How do you get around, though, some of the challenges of the continent? In particular, I'm talking about the reliance on cash and also the informal economy here. I mean, how does that play into what it is that you're trying to do?
Well, much of the world has actually become much more digital over the course of the last 3 years. It's probably the silver lining of the pandemic, and it's happened here in Africa as well. Clearly, Africa is still a heavy cash society, but therein lies the opportunity. And governments are playing a very, very important role in facilitating and trying to accelerate and set an example relative to digitization. We're doing a lot of projects with governments throughout Africa. And I just believe that there's a runway here to digitize Africa at much greater levels over the course of the next decade. And we know through several sources, including the World Bank, that if you can increase digitization, GDP will be boosted along the way.
I also want to talk to you about the U.S., which is, of course, the headquarters of Visa, and specifically about what we're hearing from a lot of executives, that potentially the U.S. could avoid a recession, and that, of course, plays into what consumers are feeling at this point in time. Based on the data that Visa has, what's your outlook? I mean, is the U.S. on a better trajectory than maybe we thought earlier?
Well, the consumer in the U.S. has been incredibly resilient. In fact, the consumer around the world has been incredibly resilient. When we look at transaction levels, they're 150% of what they were in 2019. When we look at e-commerce, excluding travel, it's 175% of 2019. And travel itself is coming back. Cross-border travel was 129% of 2019 in December, 134% in March, and 139% last month. Clearly, the consumer is doing some trading down from brands to generics. They're spending, though, the same amount or more money, but they're obviously spending more on non-discretionary items, and therefore some of the discretionary spending is probably suppressed a little bit. But I believe that I don't know if we avoid a recession, but we're going to be on the edge. But if we have one, it will be very narrow and very short, not very deep.
So and that's your projection for the rest of 2023, or how long do you think that might last?
Well, I think there's nothing on the horizon. I mean, we're really not economists, but there's nothing on the horizon that suggests any real change as we look out as far as we can.
And also sticking with the U.S., I wanted to talk about specifically what we're seeing from Senator Dick Durbin. He's really talked about how Visa and your other competitors get a bulk of their revenue from the fees that are charged to consumers and to merchants. He's trying to pass legislation yet again to rein in on that. Are you concerned at all about this for the Visa company?
Well, first of all, these fees, these interchange fees, are actually fees that go from merchants to the banks. We only set the fees. We're not the recipient of the fees. But I do think the legislation is quite flawed, and particularly at a time like this when we talk about things like the economy. The reality is competition is as good and as robust as it's ever been. I've been in payments for 3.5 decades. This legislation will end up reducing the amount of credit available to people. It will take away rewards from consumers. It will potentially increase fraud. There's many things that are problematic about this bill. And if we look back and look at the history in 2010, when Durbin went in on debit cards, there was great promise of how great it was going to be for the consumer. But what happened? The consumer lost rewards on debit cards, free checking went away, and the promise that merchants would pass along or any kind of savings directly to consumers never bore itself out. So we have an absolute airtight history case to look at to say that this legislation is not ultimately very bad for consumers. And I actually don't think very good for merchants.
Do you think it will fail then, or do you think he might be successful the second time?
I can't predict these things. I could tell you that we will work hard at making sure that we get the message out throughout the House and the Senate as to our feelings on the bill. I think there's a lot of senators and House members who sympathize with a lot of the arguments that I just made. The merchant coalition tends to be quite organized. Unfortunately, the consumers in the U.S. don't necessarily know much about this legislation, and therefore they're unaware. But I can tell you, as I've said to many of them, if you have a town hall with your folks and say, would you like less credit and less rewards and potentially more fraud, you're not going to get a lot of people cheering and putting their hands up. So I think it's, part of my job is to make sure I'm not only representing the industry, but I'm representing the consumers in the United States. But we don't take anything for granted. We'll work hard at making sure that our views relative to this act are well expressed and frequently expressed.
And let's just finish back on Africa, since that is where we are and what we're talking about here today. What is your projection for the future African consumer, especially as it pertains to what it is that you are trying to do with Visa?
Well, I think so much of this comes down to continuing to grow out the infrastructure, continuing to have more Africans have access to financial vehicles and be in the financial mainstream. And then education is obviously very critical. I think if we look at the progress that's been made here in the last 10 years, people have access to the internet has gone from 9% to 40%. We project that there'll be 650 million smartphones by the end of 2025. Yet, as much progress as has been made, citing that internet statistic, the reality is that the average country in the world is at 62.5% of people with internet access. So I look at this as a nation that has already proven, or a set of 54 nations, a continent of 54 nations that has already proven that they can make great progress. And but that said, I think there's even more to come than has happened to date, and that's the reason why we're here and why we're so excited about the continent.
Al Kelly, Executive Chairman of Visa. Al, thank you so much for being here in Marrakesh with us, and I'll send it back to you, Anna.
Jen, thanks very much. Bloomberg's Jennifer Sabasaja with the Visa Executive Chairman. Really fascinating conversation coming there from the Bloomberg New Economy Gateway Africa Forum in Marrakesh in Morocco, as we shine a light on the Africa growth story. He also talked there about the US, and he said if the US has a recession, it will be shallow. Interesting conversation. Coming up, a look at some of the market-moving events that you need to be watching out for today. Of course, the Fed's decision is the highlight. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Now let's take a look at some of the things on our agenda for the day ahead. At 8:30 a.m. Eastern Time, we get US PPI data, so another chance to talk about pricing in the US, this time at the factory gates. And at the same time, Shell kicks off its Capital Markets Day in New York. More on that in a moment. But the key event today is going to be the Fed decision. That's due at 2 p.m. with a press conference, of course, from Chair Jerome Powell at 2:30 p.m. How does he keep his optionality open for July and beyond then, Kriti, at that press conference? Let's have a look then, Kriti, at some of the pre-market movers.
Yeah, you covered the macro, I've got the micro. One of the big stories is going to be a lot of these big tech names, Tesla specifically at the top of that, adding $240 billion to their market value, a record-winning streak. And yet, here they are raising prices once again in the backdrop of the fact they were cutting them to make them more affordable, to really be able to market to the general public. And yet, here they are, higher by 1.9% in the pre-market, accompanied by two other tech names we've really been watching. Of course, NVIDIA has been at the top of our minds, higher about 0.8% this morning, but its main competitor, AMD, also unveiling an AI accelerator, a potential rival offering to what NVIDIA has to give. So AMD shares higher by 1.6%. All in all, Anna, a very clear tech bid this morning.
Yeah, I know some of the Markets Live team are a little surprised that we didn't see more positivity around the AMD story. Where do you go for those AI gains? Is it NVIDIA or is it elsewhere within the tech space? Now, a lot of people catching up on healthcare they should have had during the pandemic but couldn't get access to. That sounds great for people. But what does it mean for those who provide the finance?
Yeah, not so great for the folks who have to kind of take on the cost, which brings us to our next movers. United Health's finance chief, for example, saying that the company was seeing pent-up demand for some types of seniors' surgeries, adding to their costs. Now, Anna, this is a really big deal, not just from a kind of sector perspective, but because United Health is a massive company in the U.S. UNH is the ticker for our radio audience, down about 4.3%, making up about 9 to 10% of the Dow, and is the 10th largest company in the S&P 500. So we talk about those tech heavyweights. We forget sometimes that one of those heavyweights is actually in the healthcare space.
Yeah, just briefly on Shell.
Very quickly, Shell, really a European story. They're boosting their dividend by 15%, getting back to their oil and gas story. Might see a read-through into the oil stocks, but for now, the ADRs in U.S. trading higher by about 1.2%, Anna.
OK, let me just get to some lines coming through from Turkey. President Erdogan saying he's accepted the steps that Simsek, that's his finance minister, and the central bank under its new chief will take. So does this suggest more conventional monetary policy coming to the fore in Turkey? That seems to be the way that the market has interpreted this. Questions were asked when these two individuals were appointed as to what kind of power they would have. It seems that Erdogan is listening to them at least, and we see big moves in the Turkish lira as a result. That is it for Early Edition. Surveillance is ahead. This is Bloomberg.